see we have a pretty large audience today. My name is Neil Bawa, and I'm your presenter for the day. I'm your host. And that's me up here, the handsome guy. And I've been an educator for 17 years, and I can tell you that teaching multifamily fundamentals is my most favorite thing to do in real estate. So I hope to give you a lot of interesting tidbits today about multifamily fundamentals, the foundational concepts, the benefits, and also the risks of multifamily investing. We have a lot to cover. Let's get started. So let's start with the goal for today. Our big goal is, let's start with the big why, how. I'm going to ask you 2 or 3 very important questions, and then we're going to talk about the answers to these questions and why I believe that every one of you on the call today really needs to answer these questions for yourself. And if you don't, you're doing yourself a big disservice. We're going to talk about this massive $2+ trillion US multifamily market. We're going to talk about these latest market trends, I call them mega trends, that are driving insane multifamily growth and have been driving that growth for the last 5 years. We're then going to go on to explain how groups of investors buy multifamily properties together. So they club their funds together and they buy large multifamilies. We're going to discuss the top 6 reasons to invest in multifamily. People have been investing in multifamily for the last 150 years, and those 6 reasons have not changed during that time. We're then going to very quickly go through the life cycle of a multifamily project. And then we're going to give you, if you have time, a 2016 updates on important things in multifamily like rents, cap rates, the metros, the inventory, and what are the risks and the predictions of the analysts. Finally, we'll do a quick review. Now, before I get started, I want to tell you something very important. I'm not the kind of presenter that wants you to leave your questions for the end. I love interaction. In fact, many of you that have smartphones or tablets handy will actually be interacting with me throughout this presentation. But besides that, I want you to pop up your questions whenever you want. Whenever you type in a question, I get a flashing thought bubble on my side. It takes me a moment for me to pick it up because it's kind of small. But whenever I do, I will go ahead and answer the question. So don't feel like you have to write down your questions and wait until the end. Fire away as soon as you come up with a question. All right, now for the most boring part of my presentation, but very important. My lawyer insists that I actually read this out, so I'm going to read it out as fast as I can. We are not investment advisors, and this webinar is provided for educational purposes only. All investments involve different degrees of risk. You should be aware of your risk tolerance level and financial situations at all times. Read all investment docs carefully before making any investment decisions. All information should be researched prior to investing any money. You're free to accept or reject all investment recommendations made by us. All services that we offer are subject to market risk and may result in loss to your investment. As you know, a recommendation is not a guarantee for the successful performance of an investment, and we cannot guarantee against losses arising from market conditions. Do not invest your money on our recommendation alone. Consult a professional advisor. There, I've said it. Now, let's get to the fun part. Before we get started, let's get the audience participation set up. This is totally optional, people. You don't have to do it, but I think you'll have more fun if you do it. So from your phone or your tablet or the computer that you're listening in on, browse to this URL here, http://fai.participol.com. In most cases, you can just go into the browser and just type in fai.participol.com and notice the spelling here. You don't need to type in the www part. You know you've reached the right page if you see something like this on your screen. After you've done that, you will actually be able to interact with me. I'll ask questions and I'll see your answers come up on the screen in real time, right? It's cool, huh? You guys can tell that I'm a tech geek. So if you guys are ready there, once more, fai.participol.com. Let's get started. All right, let's start with the important questions, the big why and the how. Here's the first big why. Why can you not afford to exclusively, and I'm going to highlight exclusively here, invest in stocks and bonds? Ask yourself this question. I'm going to give you some answers as well, but you really need to be asking yourself. And the second one is, why must you seek higher yields? It's really a must, and I'm going to answer that question as well. And then the third one, how can you invest in real estate passively? No managing, no rehab, no flipping. So hopefully multifamily is the answer for you, but even if it isn't, I think you're going to learn a lot of interesting things about multifamily today. So here's my first why, right? So I asked you this question: why can you not afford to exclusively invest in stocks and bonds? And I'm going to give you three answers, and here's number one. The answer is America's Social Security system and retirement planning system was designed for a completely different reality, different time, and there are three reasons for this. Number one, life expectancy. Your great-great-grandfather worked until the day he died in the year 1900. He was probably, on average, 49 years old. By 1960, your grandfather lived to the age of 69, and their retirement had to last a few years because retirement started at 65 and ended at 69. So the system worked in 1960, and that's when Social Security was created. But now we are at 79 years, 83 years for women, and rising fast. Now your retirement has to last decades, but we have a system that substantially hasn't changed for 4 decades. So it's broken. Secondly, healthcare costs are rising far faster than inflation. How much faster? This much faster. Here's GDP, gross domestic product. Here are wages. Here, and this is insanity, is the healthcare costs. And please note that most of this comes in the final decade of your life. Number three, stock market returns, when you adjust them for inflation, they're just too low to get ahead. How low? Oh, rather insanely low, but here's an example. What is the actual annual growth over the last 15 years? That's 2001 to 2015, when adjusted for inflation. What do you think? Is it 5% a year? Is it 4% a year? Is it 10? Well, here it is. From Jan 1, 2001 to December 1, 2015, if you adjust for inflation and include dividends, the annualized return, or true CAGR, is 2.83. That means that if you invested $1 15 years ago, your buck is now $1.52. How could you possibly get ahead and save enough for retirement when $1 has grown 52 cents in the last 15 years? How is it possible? Think about that. That's reason number three. This is probably the most compelling reason why you have to look for higher yields. So what do you think you need to do to get ahead? Well, here's what I think you need to do to get ahead. Understand the magic of compounded returns and add investments with potentially higher yields to your existing portfolio. Don't give up on your portfolio. Keep the stocks, keep the bonds, but diversify your portfolio. And here's why. Look at the astonishing difference here. If you invest $100 for 30 years at 3 different levels of returns, what do you end up with? Well, at 2% returns, your $100 after 30 years has become $182. That's terrible. At 10%, that same $100 has now become $2,000. Better, but not great. Remember inflation, right? So 30 years, after 30 years, this is going to be worth a lot less. Now, here's what happens when you go jump from 2 to 10 to 18. Watch this. This is 18. It does not go like this. It goes like this. This is known as an exponential curve. That's why 18% gives you $21,000 on $100, where 2% gives you 182 and 10% gives you 1984. See the difference? $2,000 versus $21,000? Just the difference between 10% and 18%. This is counterintuitive to most people because most people understand linear returns. They do not understand exponential returns. But one of the most important concepts in your financial future is understanding the magic of exponential returns. Put another way, let's look at it from the end goal in mind. If you want to have $15,000 per month in passive income 20 years from today, how much do you need to save each month? At 2% returns, you need to save $30,000 a month, right? Rather funny, rather hilarious. None of us can save $30,000 every month, but that's what you need if you want $15,000 20 years from now. Keep in mind, this sum is going to be worth a lot less because of inflation over the next 20 years. Obviously, no one's going to save $30,000 a month, so let's look at 10%. Now you need to save $2,370 a month. Still very steep for most people. Most people are not going to be able to do this and invest in 10% returns to get that $15,000. At 18%, you only need to save $433 a month to hit $15,000 a month in passive income. So I hope I've proved to you that you need to diversify your portfolio to have areas that could give you significantly higher income than stocks and bonds can. So, time for a quick audience participation poll. If you're doing the fai.participle.com thing, if you joined late, please take your phones or your tablets to fai.participle.com. So I'm going to start you guys off with a really easy poll. Question: why must you seek higher yields? We have a broken Social Security system that's inadequate. Our healthcare costs are spiraling out of control. Our stock market returns, when adjusted for inflation, are just not enough to get ahead, or all of the above. All right, go. Let's see, 2 people. That was quick. 2, 4, 5, 6. I'm going to stop when you get. I know there's a few people. I'm going to stop when we get to 20, or 10 actually. There we go. 7. Come on, participate. Okay, not enough people have gotten onto this, so I'm just going to go ahead and give you the answer. Well, all of you got it right. Perfect. People are listening. So 100% of you said D, which is the correct answer. So be careful. The next few are not as simple. All right. So with this in mind, let's really learn about what my company, Financial Attunement, does. So once again, I'm this dude up here, and my partner, John Mark Lando, and I, what we do is we're passionate about having your assets, and I mean real estate assets, work for you, fine-tuning your thinking about capital and investing. And in case you haven't noticed, I've been fine-tuning your thinking about capital and investing for about 10 minutes now. So we buy and manage large multifamily complexes nationwide, typically 250 units or above. We currently own properties in California, Texas, Oklahoma, and Illinois. The most common question I get is, are you buying in California right now? And the answer is, hell no. We have a deep competency in asset selection and management. So our goal really is to figure out where are the right assets, what are the right markets to buy in, what are the timings that you should buy them at, and then how should they be managed for maximum investor profit. We do have decades of real estate experience, and when I mean decades, I'm mostly referring to this guy over here, John Mark. I have a decade of experience. He started in 1983 in multifamily, so I'm leveraging my partner's experience, but about 4 decades of real estate experience between the two of us. Not to mention our staff, which has many more years of experience. So now that we've gone through the basics, let's dive in and start talking about multifamily. Let's learn the basics of multifamily. So what's the first thing I need you to know? Multifamily means 5+ units. I'm not talking about 2+ units, right? Because the term itself technically could mean 2+ units, but in our world it means 5+ units, and it reaches true economies of scale, what is known as institutional grade investment at 150 units. 1 to 4 units are treated as single family, and you get a residential loan, which is bad because your own credit is involved. How are multifamily properties valued? How do you get the value for the properties? Well, they're valued based on one thing, and that's called net operating income. Very important concept. Remember, people in the trade call this NOI, so you'll hear this term over and over. It is not based on comparables. This is extremely important to understand. For example, you could have 2 apartment complexes right next to each other, identical, exactly the same size, built on the same day, and one of them has a lot more vacancy than the other one. Well, one of them is now going to be worth more than the other, even though they're next to each other, even though they're identical in the same market. Why? Because the net operating income of one of them is higher than the other. And here's why this matters. In a 200-unit apartment complex, and remember these numbers because I'm going to give you a poll about this later, the management successfully raises rents by $25 a unit. The value of the property goes up by $750,000. Why? Because they raised rents by $25 a unit. Are you kidding me? No. This is how it works. 200 units, $25 by 12 months, divided by what is known as a cap rate. This is a calculation that allows people in the industry to figure out the value of companies. 8% is a very common cap rate. These days, I'm seeing 7% more often than 8%. But I'll take 8% as the value. Well, if you do this calculation, you notice it comes out to $750,000 value increase each time. Now, you don't have to wait for the market to go up. You don't have to wait for single-family homes to go up. When you do this, let's say you do this magically in one day, your property is worth $750,000 more the next day. That's the magic of multifamily. Now, about multifamily loans. Loans are based, again, on the property's net operating income and on its occupancy, how much of it is occupied. It's not based on your income. It's not based on your credit. In fact, it's very unlikely that you as an investor will ever have your income provided to the lender, or you will have your credit run. Now, lenders do investors a phenomenal favor for multifamily. They scrutinize the property in great detail. When I'm applying for a multifamily loan, when I'm buying a 200, 300 unit, it takes 90 days for the lender to approve the loan, during which time they have looked into every rent roll, typically for the last 12 months, but many times for the last 24 months. They've looked at the property's condition. They've run a wide variety of appraisals and reports on the property to make sure that nothing is wrong. In essence, they're doing their own due diligence independent of the team that's buying the property. So they're doing the investors a great favor. Think of lenders as your friends. So where do we buy this stuff, right? So everyone talks about where. The fact of the matter is this: real estate has predictable market cycles, and these create what are known as emerging markets. And savvy real estate investors and professionals, they know how to read these cycles, and they time their investments accordingly to enter and exit markets. And this is what these cycles typically look like. So I can tell you right now, San Francisco is right here. I would say Sacramento a little bit in the middle here. It has some juice. And so does Dallas. So Dallas would be maybe a little bit higher here. Chicago right down here. But there's a few markets like I'd say Washington, D.C. and Houston that are up in this area. So still safe to buy properties in this zone. And if I was here, I would be looking to exit. Typically, you don't want to exit at the very peak because no one can actually time the peak. But you can usually tell when you've gone above this check mark. When you start seeing a lot of inflation in the market, you start seeing properties sell at crazy prices, right? So there are ways to identify these markets and these cycles and enter and exit safely. How long is an investment for? Well, the most typical investments are 2 to 7 years. In the last 5 years, the market has been so hot that 2 years has become the norm. But in the past, 5 years was the average. So that's what I'd want you guys to think about. 5 is a good average. Now, and a lot of people ask me this, why are multifamily values generally less volatile than single family? Well, it's really common sense. Values don't decline as sharply in a recession or rise sharply on the rebound because the values are based on income, and that income is not going to go down immediately just because there's a recession. People still have to pay rent. And keep in mind, all those people that are losing their single family homes in a recession, where do you think they're going? They're going to apartment complexes. Right? So what happens is you do lose some income because delinquency goes up for people that are unable to pay or lose their jobs, but then you're also gaining customers that are coming in from single family homes. So it's more or less a wash. The only thing that happens during recessions is you're not able to raise the rents by 2% or 3% each year because during a recession there is very little inflation, if any. So you kind of just sit there for the next 2 or 3 years. So that's why the values don't go down much as well, because your income really isn't going down, so your valuation is just sitting there. In the same way, when the recession finishes and there's a rebound, you can't all of a sudden start raising rents by 5 or 10% a year, so your value doesn't go up as much. So where single family often looks more like this, multifamily usually looks more like this. Classes of multifamily. Those of you that have looked at buying multifamily buildings know that people throw Class A, Class B, and Class C at you all the time. Many of you that are savvy investors also know that there what they're telling you is mostly BS. They really don't know. Most people don't know what these classes mean. Well, here's a quick definition for you, so that way you know whether a building is a class A or B or C. So A are the most prestigious buildings, affluent tenants, above average rents. Buildings are generally newer, I'd say 20 years or less, in many cases 15 years or less. Higher quality finishes, so you see a lot of granite countertops, you see steel appliances. Great amenities, there's always a pool, there's always a gym, and there's typically other amenities like dog runs. There's never any deferred maintenance. In an A, they fix it as soon as it breaks. They're exceptionally accessible, usually in downtown or close to downtown. They suffer from low cash flow and low short-term upside for investors. So for those of you who know cap rates, you typically see cap rates in the 4 to 5.5 range. If you're in the San Francisco Bay Area, 2 to 2.5% range. Most of the buyers tend to be institutional investors like pension funds that can live without cash flow for a long time. Now, in the long run, you may actually make more money on A assets because they tend to appreciate a bit more. The downside of A is their cash flow is the most sensitive to recessions. And why is that? Well, think about it. If you're only making 2 or 3 cents on the dollar, if there's a recession, well, if you lose 4 cents, aren't you upside down? Now you actually have less money that you need to pay your mortgage. So they're very sensitive to recessions. B's, the average Joe buildings competing for a wide range of users, average rents, bit older than Class A, typically 20 to 30 years. Finishes fair to good, so you typically see laminate countertops. You sometimes see newer appliances. Certainly better cash flow than Class A. Cap rates, unfortunately, are not 5.5 to 7.5 anymore. They've now dipped from 5 to 6. And you get a mix of institutional buyers. There's more institutional buyers coming into these because there's not enough cash flow on the A side. And you get a lot of private buyers. So affluent private buyers buying their own Bs is fairly common. Cs are typically, I would say, older than 30 years, not 20. I need to change that. And they're typically located in less desirable locations. So you'd really never find a C in a downtown area. They're always in need of renovation and updating. There's always something wrong with them. They tend to have lower rents and higher level of mismanagement, which is good news because they offer what is known as a value add opportunity for investors. So basically, these properties are very often broken, which means that somebody can buy them and fix them. Cap rates tend to be higher than 7%. They have the highest cash flow, and they have great upside now, but they are not going to appreciate as much as an A or a B in a 10-year or 15-year time frame. So Cs are typically not trophy properties. You buy them, you fix them, you hold on for a few years, and then you sell them. Ds, or sometimes Fs, are called really don't buy. This is not our marketplace. These are war zones. And so we don't interact with this, and so I'm not going to discuss these. All right, downsides. Everybody wants to know this slide. What are the downsides and risks of multifamily investing? Number one, it's illiquid. It is not a liquid market. It's not a stock. You can't sell it at a moment's notice. If your property is doing well, the co-investors will take it off your hands. And that does happen in a majority of cases. But still, I advise you not to think of it as a liquid investment. It really isn't. Lack of control over the investment. You've got to trust other people. Multifamily is highly, highly complex. There's a tremendous amount of knowledge that needs to be gained. You're not suited to manage a multifamily unless you've been doing it for a long time. You need to let professionals manage it. Well, the downside is there's a lack of control. You have to trust somebody else to do the job. And harder to use 1031 benefits. If you don't know what this is, don't worry about it. It's harder to use these benefits for multifamily than it is for single family. So those are the 3 big downsides or risks of multifamily. All right, now my favorite part, multifamily trends, or as I like to call them, mega trends. These are massive, once-in-a-generation trends that are creating astonishing profits for multifamily investors. So the first one is that there's a big fundamental change taking place across America. I think most people know about this, and that is rent is the new buy. Americans now prefer to rent, and the mouthpiece of the single-family homes, the National Association of Realtors itself says that 5 to 6 million new renter households will be created within the next 10 years. It seems that Americans are not in a rush to buy anymore. And this change is really driving long-term demand for multifamily properties. Ownership is not in the cards. The Wall Street Journal and Napfolio did a survey, and the survey said only half of all renters said they anticipated becoming homeowners in the next 5 years. That number is the lowest it has been since the survey was started. And if they're not buying homes, they're not buying homes even if they qualify for mortgages. In fact, these are the top 3 reasons why they don't buy homes. Number 1, the lowest one, can't get a mortgage. Number 2, don't want to own. Number 3, enjoy renting. And you notice which one of these 3 is the biggest. Renters are liking the freedom of the renting lifestyle. And why are they liking it? Well, because of these reasons. Good schools, safe neighborhoods, parks and playgrounds, community centers, friendly neighborhoods. Well, you can't get any of these for single family anymore because you're getting priced out. This is especially true in the San Francisco Bay Area. So they'd much rather rent, not have to deal with the hassle and the stress of having a mortgage, and be completely mobile. Now, this very important group called the Millennials are clearly not buying homes at the same rate as the previous generation. If you look at this graph, Millennial home buying peaked in 2005, well before the recession started, and they were at a little bit over 17%. Now in 2016, they're down to under 13%. This chart only goes to 14, but they're around 12.5% at this point in time. So these trends have been declining now for 11 years. There is no doubt in my mind that the Millennials don't buy homes at the same rates. What about the baby boomers? Well, they're beginning to downsize, but they're doing something odd that Generation X and Generation Y did not do. They're starting to downsize to apartments instead of downsizing to homes. They're looking to urban apartments for convenient services, easy access to amenities, or some people think they want to move closer to their kids, the Millennials who love living in the cities. So these people, they're known as echo boomers, and they're really impacting the total amount of inventory that's available for multifamily, because nobody had really thought that they would go to urban apartments instead of buying smaller houses. So those were the mega trends. Now, if you're listening, are you ready for an audience participation poll? Here we go. Which of these mega trend statements is true? Note there's only one right answer. Millennials are buying a lot, but baby boomers are downsizing. In the Wall Street poll, the biggest reason for people not buying was cannot get a mortgage. Millennial home ownership rate is increasing since 2005. Buy is the new rent. Millennials are not buying at the same rate as the previous generation. Those are your 5 options. Which one of these 5 is correct? Okay, people are taking more time to read this one. I see people voting really slowly. 5, okay. Come on, give me a couple more. Guess. More. Going once, going twice. All right, one more, there we go. Okay, so the right answers. Everyone got it right, yay! All right, the right answers is Millennials are not buying at the same rate as the previous generation. So these trends, these mega trends, represent an opportunity. And I believe that multifamily could have a decade-long runway in front of it. And I want to now show you how you can benefit from these trends. Oh, I also see that there's a question. Let me take that question. Oh, people are actually answering me on the chat as well. Okay, well, it looks like almost everybody got it right on the chat. Good job, guys. So, buying together, how groups of investors can buy multifamily complexes. Here's the basics. The concept of group buying is typically referred to as syndication. Multifamily complexes are expensive, so are commonly purchased by groups of investors using a mechanism called syndication. The rules of the syndication are governed by the Securities and Exchange Commission for the protection of investors. An experienced multifamily syndication team, such as ours, finds an asset to purchase and then offers the opportunity to pre-screen investors who can then choose to participate or not participate in the acquisition, or who can buy. individuals, self-directed retirement plans, IRAs, family trusts, entities such as LLCs. They can all invest varying amounts, so people can invest different amounts and receive a proportional equity share, both of the cash flow and of the value gain for the property. The syndication team itself does all of these things: finds, contracts to purchase, due diligence, organizes offering, pools funds, manages property until sale. For making the opportunity available, they receive a share of the cash flow and a small management fee. Who manages the property? The management team doesn't manage the property. They assign an asset manager, and they also assign a property management company, a third-party company, to run the property. Investors have no involvement in day-to-day running of the property. No tenants, no toilets. Cash flows are typically dispersed quarterly. This is very common to investors who often, in our case, always receive what is known as a preferred return before management team is paid. Preferred returns are very key, because what that means is this is not a hedge fund where the hedge fund manager will get paid millions even if they don't make no money. Preferred returns mean we have to perform as a management team to get paid. Alrighty. Why invest in multifamily? The top reasons why multifamily investment should be part of your portfolio. Now, didn't I just give you a bunch of mega trends? How's that different from this? Well, the mega trends are recent, right? The Millennials and all those kinds of things are recent. But people have been buying multifamily for 150 years. So there must have been reasons that always existed. Yes, there's dozens of them, but let me give you the top 6. Number 1, cash flow, cash flow, cash flow. The property has to generate income to cover all the cost of operation, all the capital improvements, and the financing, the mortgage, the debt. And rest goes into the investor's pocket. While the exact return will vary upon, depend upon the property, double-digit annual returns are common. And very high double-digit annual returns have been common in the last 3 or 4 years. Second, forced appreciation. Do you remember that whole graph that I gave you about how on a 200 unit, when you raise rents by $25, all of a sudden the property's value goes up by $750K? Well, that's forced appreciation, right? Because if you double the value of the property, you can double the value. If you double the profit, you can double the value. Even with stabilized properties, you can optimize the management, and that can yield really big returns. Remember, just $25 can move the needle by $750,000 in value. The more distressed a property, the greater the discount. So the good and bad of buying distressed properties is, well, you're going to get a big discount at purchase, but you're going to take a much greater risk that you're not going to be able to turn it around. So working with stabilized properties and micro positioning raises fewer problems, but then you have a lower gain. So make sure that you're working with experienced managers and rehabbers when you're investing in multifamily. This is my favorite. I worked as a chief operations officer for 17 years in an education company, and what I cared about was professional management and metrics. Metrics every day. An asset management and property management team oversees the property, and they use metrics: sales, cost, profit. And these metrics are looked at every single week, which is what makes multifamily a truly passive investment for the investors. We are required to report these statistics to you on a monthly basis. Now, many multifamily operators don't do this. Our company does it, and we send out very detailed documents that show all these metrics. Inflation protection, right? Most people understand this. So in a world where every central bank is printing large amounts of money, we are in an environment that teeters between deflationary and hyperinflationary. I think that it is wise for you to have some real assets. Real estate is a real asset. Other good real assets that I own myself are gold. Substantial amounts of gold is also beneficial. But the problem with gold is it doesn't give you income. Real estate gives you income every single month. Tax benefits. Multifamily properties are able to take advantage of what is known as depreciation on the building and equipment to help offset income. Let me give you an example. On our last property in Chicago, we are expecting that the first 9% of annualized income is going to be completely offset by what we did, which is known as accelerated depreciation schedule. Obviously, at some point, you're going to have to recapture this, but that may not happen for 6, 7, 8 years down the line, and is likely to happen at a lower tax rate than if you were to pay ordinary income on this today. Ordinary taxes on ordinary income. Sorry, I didn't say that right. So, top reasons to invest in multifamily, number 6. Another one of my favorites, huge economies of scale, right? So, if you have a single family and it becomes vacant, your vacancy is 100%. If you have a 250-unit multifamily and even 10 people left today, that's only a 4% change in vacancy. Not 100, 4%. Your marketing is more efficient. You're driving everybody to the same property. Your logistics are easier. All of your maintenance is done off of a single building. Repair and maintenance is very cost effective because guess what? Even if your property is awesome and it's at 98% occupancy and it's 250 units, guess what? 5 units are empty. So those 5 units can be upgraded without you taking any kind of rent hits. Dedicated employees are easier to manage than contractors. A 250-unit property either has 5 or 6 dedicated employees. And of course, you can carry out upgrades, which I just mentioned, with less impact on revenue. So those are some of the awesome reasons why people invest in multifamily. Now, let's go. I'm going to take 5 minutes to do this. I'll give you the life cycle of a multifamily project. I'm going to go through this real fast. 4 phases: pre-offer, post-offer, post-purchase, sale. First phase, pre-offer, metro research. You visit the metro, you start looking at the jobs and high-paying, high-quality jobs, and the path of progress through a particular metro. The pricing trends in that metro. Are prices going up? Are they going down? You start creating your team. Realtors, inspectors, property managers, contractors. These people will tell you a lot of things that you don't know about that particular metro. This team is really critical to your success. Now you start narrowing the metro into certain neighborhoods and certain submarkets, and you start doing your opportunity search within those target areas. Once you've started going into these areas, you start walking what are known as comps, similar sized properties that may or may not be for sale. I actually like walking into comps that are not for sale. The property managers there are very friendly because they realize I'm here to buy another property and they want my business. They're a property management company, right? And so they give me loads of information that I didn't have before. Opportunity is found, first offer is made, and the first offer is made based on the seller's financials. I have to tell you, the seller's financials are almost always wrong. But you make the first offer based on their seller's financials, and you say that you're making the offer based on their financials. So that way you're protected. Now, the fun part, post-offer. You start doing 3 phases of due diligence. Number 1, you start doing due diligence on roof, sewers, repairs, unit condition, carpets, hallways, exteriors, electrical, plumbing, and mechanical, or MEP. Any of these that you don't do your due diligence right on could cost you $100,000 to $500,000. Phase 2, you start verifying the financials that the seller has given you. Are the rents coming in? Is there very high delinquency? Is there some evidence that he's giving away a month of rent for free every year just to keep his rent dollars up? Are his occupancy levels real? And is his staff competent? If the property is not doing well, I really look at this area. And the third phase of due diligence, walk comparable properties again. Now, didn't I just walk them before? Yes, but back then I didn't have a property that I'd made an offer on. So I go back and walk those comps again. And typically I walk a larger number of comps that are on sale or off sale to ensure that our pricing, the assumptions that we've made for rents are sound and that the property is actually a good buy. Then you go back to the seller and say, I need a repair credit. And usually that repair credit could be anything from 1% to 5% of purchase price, depending upon the condition of the property. Sometimes you go back and ask for a price reduction if all their numbers turned out to be wrong. And if the seller doesn't agree, then all the work we've done so far completely goes to waste and you restart at phase 1. If he agrees, then the team start promoting the opportunity to investors through webinars and detailed investor summary documents and financial projection documents. Lawyers create all kinds of LLCs, usually multiple LLCs, to protect the investors and the management team. And the purchase is typically completed within 75 to 90 days. Post-purchase. Management now starts making changes to the property management team, retrain or replace. Just so you know, we tend to replace 80%. Management makes upgrades to the amenities, so we start making upgrades to pretty much everything that the tenants care about: interiors, exteriors, curb appeal, parking lots, leasing office, gyms, all those sorts of areas. And then we start transitioning out or evicting undesirable tenants. A lot of C properties have undesirable tenants that are not paying well. We come in and we're fairly ruthless in evicting these people because they bring the place down. And we bring in better tenants, and when we do that, we usually bring in those better tenants at significantly higher rents. The repair budget that we negotiated is used to improve the asset. So we're spending money not just on visible things, but on things that we need to fix so that we don't have issues later. Each quarter, the investors get checks for any available cash flow, and then they receive financials, and they get a property report, a very detailed report from the management team. All right, phase 4. So now the apartment complex is fixed, so that the management runs the complex for 3 to 5 years. With the market appreciation and with proper management, the property's NOI, or net operating income, is expected to increase. Typically, by year 5 or before, the property's NOI, net operating income, reaches the exit projections that we provided our investors when we were pitching the project to them 5 years ago. Management then puts the property up for sale and aims to complete the sale. Typically takes about 6 months to sell a property. And investors now receive their principal back along with any profits, hopefully a very large amount of profit. So that's your cycle, and that's a typical life cycle of a project. All right, no questions so far. So I'm going to spend about 5 minutes telling you a little bit about multifamily in 2016. What are the predictions from the analysts? What is 2016 going to look like? So prediction number 1 is from Integra Realty, which has 800 analysts assigned to the multifamily market. Outstanding performance in 2015 stimulates confidence. So they're saying it's difficult not to be bullish. Strong hiring numbers are providing momentum. This has driven vacancy rates to 14-year lows, but is still boosting the absorption of new units. Steady demand growth is expected to maintain current vacancy levels in most markets in 2016. Provided employment gains continue, and they've been really good in Jan, Feb, March, and April. May was kind of a shocker. The multifamily market will enjoy continued investment interest due to pent-up demand, current buy versus rent preferences, and the need to replace post-war inventory. Here's a prediction from PricewaterhouseCoopers. We think that the demographic tailwind for rental apartments and continued urbanization is a longer-term trend that will make multifamily a good sector for a long time. That's not me, guys. That's PricewaterhouseCoopers, the guys that are handing out the envelopes at the Oscars. Here's a question. Okay, question from Kayur. What specific markets are you buying in today and through this year? So the answer, Kayur, is you need to interact with me more. I'm not supposed to be telling you about the specific markets the first time we interact. So feel free to talk with me, and I'll be happy to give you the list of markets. Kayur again, what entry cap rate are you paying and exit cap rates you're projecting 5 years from now? Currently, for a B, entry cap rates are somewhere in the 5.5 to 6 range. For a C, they're somewhere in the 7 cap range. We are projecting that 5 years from now, exit cap rates are going to be similar but slightly higher. Garrett's question, why a 5-year exit? The answer is, Garrett, because investors don't want to stay in there for an indefinite amount of time. And typically, we target 5 years because if all goes well, in 5 years, the investor's money can be doubled. So it's a nice round number. Question from Parth. Will we get a recording of this webinar? Yes, Parth, you will get a recording tomorrow. All right, prediction number 2, cap rates. Cap rates are expected to stabilize for 74% of the major metros. They've been going down, which is good news for multifamily investors. Lower cap rates means more money. A small number of metros should see declines, and those are mentioned here, Washington, D.C., and Houston. And some metros will actually see small increases in cap rates. Actually, this is reverse. A small number of metros should see increases in cap rates. That's Washington, D.C., and Houston. And a small number of metros will see further declines in cap rates. Declines in cap rates means If you've got a property there, you're good, you're happy. And you notice that there's been a decline here, which is why the profits have been going up for the last 4 or 5 years. Rent growth. So here's a really good news. CoStar says that there's strong rent growth in 2016. Notice that the long-term trend was here, 2%, and that trend started to change right around 2012. And since then, we've had 6%, 4%, 4%, and then back up to 6% in 2015, and back down to 4% in 16. Just so you know, for an apartment guy, 2% is fine. 3% is great. 4% is champagne time. 6% is kind of insanity, and I don't expect that to happen again. And CoStar again says, which multifamily class will outperform? I gave you class A versus B versus C. Well, CoStar solidly thinks that B and C are going to outperform A. Why? Because the vacancy for A's is going up. For the last 24 months, the vacancy for A's has been going up. When vacancy goes up, profits go down. But the vacancy for 3 stars and 1 and 2 stars, so this is a class C, this is a class B, have been steadily declining, which means that profits are going upwards. Which multifamily class will outperform? This is PricewaterhouseCoopers. The last page was CoStar. They think that we should be looking at the garden apartment subsector. Just so you guys know, all we buy, all my company buys, is garden apartments. Another question. How many investors are usually part of the deal? Well, mainly that depends on the size of the deal. My Chicago investment has 52 investors because over $3.5 million was raised. So at about 80K a pop or 75K a pop, there's about 50 investors in that deal. But it really depends on the size of the deal, Wendy. All right, bottom line in multifamily in 2016, the economy is strong, will support rent growth. Having said the market's a little bit frothy, which means that the growth will moderate. Almost every metro is in expansion mode, but many expansions like DC and Houston are getting very long in the tooth. And there's going to be a gradual reduction in average returns and yield as investors have managed to bid up prices. So you're probably not going to make as much money as you made in the last 3 years. Do expect vacancy increases. Well, this actually turned out to be wrong in many metros. Expect cap rates to stabilize and be careful with your metro picks. So this is a time where you have to be really careful with picking the right metros. So here's a recap. You learned about the $2 trillion, $2,000 billion US multifamily market. You now know that there are once-in-a-lifetime broad generational market trends that are driving the growth. We discussed top 6 reasons why people invest in apartments, and then you learned how investors buy properties together. You went through a life cycle. Now, for those of you that are interested, let's spend 90 seconds on next steps. If you like this, please take action. Oh, I'll take a question. Come on. There we go. So since we have access, so here's a question. I'm not going to mention this person's name. So since we have access to capital, can or would you be an excellent JV partner, knowing what you know? The answer, Devi, is I get asked that question very often. So folks that have capital are looking for performers or drivers of projects, and we welcome a conversation about that. Wendy's question, can you do 1031? The answer is, for small amounts of money, no. For large amounts of money, yes. All right, so here's an investment opportunity that actually may be sold out later tonight. Chicago PMO is a project that we purchased. It's a 237 unit project that we bought in a neighborhood that has strong potential. This is in South Chicago. We took over in December. Demand really has been spectacular. We received over 300 leads a month, getting closer to 400 now. We schedule over 200 appointments a month. We get 30 apps from people that are paying for these applications. All of these numbers are double the original projections. Our initial rent estimates were conservative. We are already at the magic $25 number. For all 4 types of units, we've raised rents by $25, and for our 3 bedrooms, we've raised them by $50. 66 of the first 73 approved leases are above the projected rents. Despite some challenging and annoying delinquency issues, the projected 18-month turnaround should be now completed on this property in 1 year. So we're excited that the delinquency actually pushed us to clear out some of the bad tenants quickly. So if you're interested in this particular property, or you just want to know about what a property looks like, you're not interested, you just want to learn more, please write down this URL, www.financial-attunement.com/next, and you'll get a high definition video there of this property and also all the docs. I'll take one more question. How many projects have you done in the last 12 months? The answer is, Alina, we do 2 to 3 projects each year, no more. Is the Chicago project typical, small, or large? The answer is slightly on the smaller side. So we're typical project. Our next project is going to be $15.5 million. Okay, let's skip. And so, why did we like Chicago? Most people go, why did you invest here? This area is very special. 1 mile to the north of us is Hyde Park, where the President of the United States, President Obama, lives. And that area obviously has rents that are much higher, 40 to 60% higher. Notice there's no apartment complexes between us, just a park. 1 mile south of us, a billionaire family called the McCaffreys is building a $4 billion project with 14,000 Class A dwellings, and they're going to be selling them at $250,000 each. We bought our project at $50,000 a pop. 1 mile north or northwest are 2 possible locations for the $400 million Obama Presidential Library, a huge project that will bring 3,000 jobs there. Obviously, I'm hoping it goes into Jackson Park and not into Washington Park. University of Chicago is massive. They're using their $1 billion endowment to buy up homes for student housing, and as they buy more and more homes, it's creating intense pricing pressure, which is coming down towards us. So we made a bet that that pricing pressure over time will increase prices and increase rents. More questions. What is your management fee? So our management fee is divided into a number of tiers, Garrett. I'd be happy to discuss that with you one-on-one. It's a complicated process because I have to give you a big example, but keep the number 4% in mind. But that's just a beginning. There's a few pieces of it that you need to know about. All right, what are analysts saying about Chicago? This is very important, right? UBS Bank's new report shows that Chicago is the only undervalued city amongst the world's top 15 cities. Bloomberg wrote an article warning against significant rent hikes when subsidized housing switches to market housing, and South Shore, our neighborhood, was the highlighted neighborhood nationwide. Marcus and Millichap's report in 2016 raised the estimate of Chicago rent increases from 3.3 to 6, and they estimate further increases in occupancy, both of which are good for us. And finally, this is the one that I like the most. Chicago was named the nation's top metro for new and expanding companies for the 3rd year in a row by Site Selection magazine. So we raised all of the money for this particular property. We bought it 5 months ago, so we know a lot about it. We have 2 shares left. In fact, I think now we have 1 single share left. So this is the last time you're going to be hearing about it in a seminar. All right, that was my presentation. It's time for you to type in the questions. I know it usually takes 30 seconds for people to type in questions. In the meantime, I want to remind you of something. I enjoy meeting with people one-on-one. As you can tell, I'm very passionate. I love real estate in general, not just multifamily. And I'm happy to meet with you one-on-one. In many cases, my partner hates, me doing this because he says, Neil, you're driving away a whole bunch of people. And the answer is yes, because we weren't a good fit for them. So I'm happy to meet with you, buy me coffee, and I will meet you at a local Starbucks and we can discuss what you're doing in real estate, and hopefully I can point you in the right direction. So with that, I will take questions. I know I've answered a bunch of questions already, but I'm pretty sure there's more. There's 45 people out there. There must be more questions. Here they come. What's your direct email? It's at the bottom of this screen, Kayur. Neil, N-E-A-L, at arcfunding.com. More questions? I get a question by email every single time after I do this, so let me address that. This webinar was recorded. You will get a copy of it tomorrow. You'll also get a copy of the PowerPoints. JL asks, are you taking accredited investors only? The answer is for the Chicago investment, that is correct. In accredited investors only. For our next project, no, taking accredited and non-accredited. Can you share your success rate? That's very difficult to do in a presentation, Alina, but if you drop me an email, I will send you the current returns for all of our projects. Average returns per couple of latest projects over the last few years, I'm guessing, Alina, but we're somewhere in the 30% range. But I'll send you the whole thing if you ask me. You just send me an email and I'll respond back with our portfolio. So how many projects do you typically handle per year? We try to handle 3, but we've mostly been handling 2. Kayur, is the Chicago deal is set and ready for acquisition? Davey, we bought it 5.5 months ago. We're raising the last few percent of the raise. We bought this property already in November. We've been running it. We've turned it around. We've signed 73 leases. We've kicked out 30 delinquent tenants. It's a done deal. So is Chicago a Reg D, B, or C? So Chicago is a C, Kayur. Sorry, that's a complicated question for those of you that don't understand it. Ignore that, but it's a C. All right. Any more questions from anyone? It is exactly 7 o'clock. I'll take a couple last questions. Where's your next project in? Then I'm not supposed to give that information to you in my first. I don't recollect talking with you. So let's chat and I will be happy to give you a list of states that I've made offers in. Right now we are in a very offer heavy state. We have 4 offers out. Given how hot the market is, I wouldn't be surprised if we get turned down for all 4 of them. When do you start your next project? Jyotsana, we start our next project hopefully within the next 3 weeks. We are pretty much done with Chicago. So we're hoping to get a property in contract in the next 3 weeks. My partner right now is on his way to an unnamed city where he has made 3 offers and we are making a 4th in a different city. How do we find out about your next projects? It's straightforward. You send me an email. My email is at the bottom of this page and say, please include me in your investor list. I'll tell you what to do next. All right, I'll take that as the last question. Thank you all for attending. Hopefully you learned a few new things. And if nothing, I'm sure you learned that I'm very passionate about multifamily. I'd love to talk with you more about multifamily or real estate in general. Buy me coffee. I live in Fremont. We'll see you around. We have a very interesting event coming up in Fremont 2 weeks from today. So hopefully you'll attend that as well. One last question, and that's a good one, so I'll take it. Minimum capital, the answer, Jyotsana, is 50K. We don't take less than 50K. Well, thank you all for attending, and I will be sending out a copy of this presentation to you tomorrow. Thank you, goodbye, and good night.